Over the weekend, in a major escalation of the crisis in the Middle East, Iran launched a retaliation attack against Israel, firing dozens of drones and missiles which were intercepted by Israel's defense systems and their allies. This comes after an Israeli airstrike that destroyed the Iranian consulate in Syria on the 1st of April. Iran has stated that with these retaliation attacks, the matter could be considered closed. The most immediate impact, however, is higher oil prices, and that is really due to the risk of oil supply disruption from the Middle East. Should Iran decide to block the Straits of Hormuz, it could potentially choke off around 21 million barrels a day, or approximately 21% of the world's oil consumption. A sharp increase in oil prices, therefore, could reignite expectations of higher inflation into the future and potentially see rate cuts being postponed. Oil futures so far, luckily, suggest that investors think that higher oil prices will only be temporary. Of course, if the conflict in the Middle East escalates further and Iranian crude oil is sanctioned, the total spare capacity in OPEC, fortunately, currently at around 6 million barrels a day, is still sufficient to make up for Iran's supply. It is also important to note that the impact of regional wars tend not to have a lasting effect on markets. We have seen this in the ongoing Ukraine conflict as well as most of the other conflicts all over the past few decades, including the two Gulf Wars and also the 9/11 attack. So what can investors do? An escalation of the conflict, especially if other countries such as the US are involved, would likely trigger a short-term sell-off in stocks. The key level of the Brent crude price to watch right now is $100 a barrel and even higher. We think that US dollar will continue to stay firm. However, the long-end treasury yields could continue to decline and gold prices will stay firm. Now, if the escalation stays regional, the sell-off is likely to be short-lived and strong fundamentals in these stocks will likely return to drive prices higher again. Next, we continue to recommend switching away from growth stocks to sectors such as energy, commodities, industrials, and financials. Inflation fears could result in selling of such stocks and sectors that has higher valuations as investors are rushing in to lock in short-term profits. Next, investment-grade bonds remain still relevant to stabilize portfolios in a volatile environment. And lastly, maintain an allocation to alternative assets which have a lower correlation to stocks and bonds. To find out further how you can navigate through these volatile markets, do speak to your UOB banker.